One of the things that was announced last week around Bitcoin was Bitcoin mining for an IRA account. And so if you understand how to get Bitcoin, people always ask me, how do I get more Bitcoin? Well, you can do three things. You can either buy Bitcoin, you can earn Bitcoin, or you can mine Bitcoin, right? And so buying it means you take fiat dollars and you convert it into Bitcoin. Mining it means that you take fiat dollars, you buy machines, computational power, and you leverage that or rent that to the network, and it pays you in exchange for that computing power. Or the third thing is you can earn it, meaning that Joe owns a business. I call up Joe. I say, you know what? I'm great at doing A, B, or C task. Will you please pay me in Bitcoin? And he decides whether he's going to pay me in Bitcoin or not. Buy it, earn it, mine it. Those are the three ways to get Bitcoin. And so last week, IRA provider Choice, which I'm a very big fan of, I actually have an account at Choice where I own GBTC in the account. Ooh. That's pretty much all I own. The IRA provider Choice and Compass Mining announced last week that they're offering an IRA that will allow miners to generate crypto into a tax-advantaged account. Now, this is really interesting because we're going to get to some stats in a minute that show that the IRA accounts in America and the retirement kind of status of Americans is very bad, shocking. And so what this is going to allow people to do is it's going to allow people to mine Bitcoin and then have it deposited into that retirement account. And so if it goes into your retirement account rather than, let's say, a non-retirement account, you normally would have to pay income tax if it went into your regular account. But if you mine it and it goes into your retirement account, the thesis here is that you will not have to pay income tax on it. It'll essentially be almost a contribution to the IRA account, and then it can grow tax-free in these accounts. And depending on which type of account you put it in, you will either get taxed on the when you take it out or not. And so the idea is a customer first needs to buy mining hardware by using assets within the IRA. So key piece is you have to buy the hardware with assets in the IRA. And then the equipment is ranging from $5,000 to $10,000. Compass handles the logistics from delivering those machines to data centers to configuring and monitoring the gear. And then if clients subsequently choose to sell, the capital gains taxes will be deferred or eliminated completely if done within the IRA. So you basically take IRA dollars or retirement dollars, you buy machines, those machines then generate income, but that income is held within the retirement account and therefore it is shielded from any sort of capital gains tax. It's either deferred or it's eliminated. Now, that sounds like an awesome idea. And if you like Bitcoin and you don't want to buy it, you don't want to earn it, this is a great way to get more Bitcoin because you can mine it. And you can do it in a tax-advantaged way. And as we've talked on the show ad nauseum, is one of the best ways to increase your income is to simply use the tax code to your advantage or to kind of follow the rules within the tax code, but understand those rules. But not everyone agrees with this. Some people claim that the income generated from investing your IRA funds in mining crypto could be subject to something called the unrelated business income tax if the mining is deemed a business or an active trade. And so it is yet to be clear. Obviously, Choice and Compass believe that this is shielded from those tax clauses and aspects. But some people think that the unrelated business income tax could apply here. But regardless, what we see is the head of tax strategy at CoinTracker said, quote, "It is just another way of earning income inside a self-directed IRA account because the advantage is that you're not picking up income. You're just kind of saving for retirement." And so if this is true, and the IRS does recognize this as a way for you to essentially save into your retirement account, but not with dollars that you're contributing. Instead, it's using machines that were bought with retirement dollars to generate more income and get that into that retirement account. It's a pretty interesting strategy. Like, I really like this. I think this is pretty freaking cool.
I'm interested to see what happens in like the long term.
In what way?
If it's deemed a business or not, right? Because you're buying something that's generating income for you.
Yes, but is it a business if you buy a computer? I don't know. I'm not a tax.
It could be a business expense.
I'm not a tax attorney. I'm not an accountant. I don't know what the answer is, but I think that it's super interesting that people are considering it.
But just thinking out loud, like, how is this that much different than what Peter Thiel was doing with his IRA?
Well, he put shares.
Yeah, shares.
He didn't. I don't think that he took dollars.
I mean, there was no
and
income,
bought shares. No, I don't think he took dollars and bought the shares.
Yeah, he just contributed.
I think he contributed the shares. That's one main difference. And two is the income versus the capital appreciation of the equity itself. Right.
For those of you who weren't here, Peter Thiel has an IRA worth $5 billion.
Despite publications saying his net worth was like $2 billion.
Yeah. I think Peter Thiel's got a little more than $2 billion. Yeah. All right. So how bad is retirement in America? The Best Business Show research team, Joe and John, co-heads, went and did a little digging. And newsflash, it is horrible. 2021 total contributions you can make for your traditional IRA or Roth IRA can't be more than $6,000 or it's $7,000 if you're 50 or older. And that's up from the $5,500 it was previously. But you can't withdraw until you're 59 and a half. And if you take it out earlier, you're taxed. What ends up being really, really sad is let's look at the percentage of Americans who have no retirement savings. 60 years old or older, 13%. More than 1 in 10 Americans have no retirement savings, and they're at retirement age. Not good. If you even look at 30 to 44-year-olds, 1 in 4 of them have 0 retirement savings. And then obviously, if you look at younger people, it's almost 50%. And so when you start to look at this, the younger people, we should expect them not to have a lot of retirement savings, but to have 0 is pretty shocking. To be in your mid-20s and have $0 in your retirement savings, very, very concerning. Even if you put $10, $100, $1,000, something, get started. 1 out of every 2 people can't possibly have no retirement savings. And then when you start to move into kind of more of your working age, 30 to 44, to still have 1 in 4 Americans with 0 retirement savings. I don't care if you don't have great retirement or a lot of money saved for retirement, but to have 0 at 30 to 44 is concerning. And then when you basically get over 45 to still have 13 to 17%, depending on your age, to have 0 retirement savings, I mean, this is really, really concerning.
Just one quick note is the average age of retirement is 61 years old.
61. Not everyone always thinks it's 62, but it's actually 61.
61.
Yeah, it's all the young retirees pulling down the average a little bit, trying to get a little lower. Nobody's trying to retire later, right? So it always seems to be everyone's trying to retire earlier. All right, then we're going to look at the average and median retirement account balances. And if we compare 2016 to 2019, you can see that the 2019 average retirement balance was $255,000, which $255,000 at retirement age of, let's say, 61, if you just live until you are 77, give or take, which is the average life expectancy, that means that you have 15 years of which you basically have to live on $255,000. Now, if you've invested it correctly, you should be able to continue to have it appreciate in value. Hopefully, you can have it in some sort of cash generating type return so that you can actually drive income off of it. Maybe you're also pulling on Social Security or some other type of retirement program. But to only have $255,000 and still have 15 plus years of life until the average life expectancy hits, what you find is that an individual would be living on somewhere less than $20,000 per year. That is very, very difficult. That's below the poverty line in America. So the average retirement balance in America, when you retire at the age of 61, ends up having less money in it than what would meet the poverty line to live just to the average life expectancy. That's not good. That's really bad. And then when you look at the median, it's even worse. So we're just going to go with the average, which allows for things like Peter Thiel's $5 billion retirement account to pull the average up, right? The outliers up. But really, really, really concerning stuff. So not only is there a high percentage of the population that has no retirement savings, the people who do have some retirement savings, still super concerning.
Well, not to mention when you lose a significant amount of your purchasing power in a year like we just had this past year, right? 10%, some people think inflation-wise.
I saw a statistic. We don't have the charts, unfortunately, because I didn't know we were going to talk about this. But one of the highest percentage of people who in March 2020, when the stock market crashed, 25%, almost 30%, one of the highest percentage of groups that sold stock on the way down or at the bottom were retirees, people later in life, because what they historically had known was if you were buying stocks at, let's say, the top of the dot-com bubble, then you basically had almost a decade until the stock market got back to those levels, or a number of years till you got there. And so what they said was, I might not have 10 years left to make back this money. I'd rather just take the 20% haircut, sell the stocks, get the cash, and I'll just live to fight another day. But then obviously what happened was, as they were selling the stock at depressed levels or even at the bottom, then the stock market turned around and ripped to all-time highs, and still even today continues to hit all-time high after all-time high almost on a weekly basis. And so the people who are later in life, they got hit with the global financial crisis. After the global financial crisis, a lot of that generation got completely destroyed financially or significantly hurt. They then became much more savers than investors through the first part of the longest bull run in history. And so they were holding on to that. They were saving. They didn't want to invest in the market. They were scared of another crash, all that type of stuff. Then in 2015, 16, 17, 18, they started to invest more because they realized it's only going to go up. And right when they started to do that, 2020 happens, goes down. They sell stock because they're worried, and then the market rips on them again. It's really sad, but when you start to look at, not only do they not have a lot of, or a higher percentage than you would think of retirees did not participate in the 100+% increase that we see in the stock market over the last 15 months or so.
So I just looked up, because one of the charts I saw the other day that reminded me of that was Microsoft. And Microsoft, from the peak of the dot-com bubble, it was at $55 or $60 a share. And you're up 500, 600, 700% now from that time period, but you didn't recover and you weren't back kind of in the profit until 2016. So 16 years it took you to recover from the dot-com bubble. So you had people that, sold in 2008, sold in 2005, sold in 2012, sold in 2015, whatever it might be. They ended up losing money on that trade despite the stock being up 500, 600% since then.
I mean, it's just nuts. Right? We've got one more chart here. If we look and we see the median retirement account balance by age, John found this chart. John was deep in the interwebs. I don't even know where you found this one. This is the 401k or IRA balance. 35 to 44, $37,000. 55 to 64, only $100,000. Right? And I say only, realizing that 13 to 17% of people over the age of 45, depending on your age, have zero. 80 to 100,000. You cannot retire on that, right? Like, if you are relying on a company pension, you are screwed. If you are relying on living the last 20 years of your life at the age of 55 on $100,000 in your retirement account, you are screwed. You cannot do that, right? What are you going to do? Live on $5,000 a year?
They're going to go to another country.
Again, you can do all kinds of stuff. If you get in the situation or you are in that situation today, there are things that you can do to mitigate the damage or try to improve your situation. But if you're a young person, which most of the people who watch this show are young, do not make decisions that will put you in a position at 55 years old to be sitting there with $100,000 in your retirement.
So I just did the math on this real quick from like an educational perspective. So if you
wait, how do you do math from an educational perspective?
No, I'm saying I'm going to tell you the example for an educate, because it's one thing to say, hey, look, this is terrible. You only have $80,000 to $100,000. You're not going to be able to retire. But how do you fix that, right? So I just did. If at 25 years old you start a Roth IRA, you put in $1,000, and then you contribute an extra $1,000 per year. So less than $100 a month. Right?
1/6 of what you're allowed to, though.
Yeah, 1/6. So you only do, not only, but you start with $1,000 and you contribute an extra $1,000 per year from the ages of 25 to 65. The average stock market return over the last 2 or 3 decades is 10%. So if you compound
allegedly
8
to 10%, yeah.
Well, it depends what index you're looking at, but I use 10% for my math. You'd end
math guy.
Your Roth IRA at 65 would be $532,000, or 5 times what the average is currently, or the median right now.
Okay, so explain.
$1,000 you start the IRA with at 25 years old. So you put $1,000, you saved up however you got it, you put it in the IRA. Then you contribute an additional $1,000 per year from 25 to 65.
Okay, so now you basically put $40,000 in plus your original $1,000.
Plus your original. And then it compounds at 10% annual over that same time period. You would end with your Roth IRA an ending balance of $532,000 when you're 65, and $262,000 of that would be taxable savings. So you'd save $262,000 in taxes.
Okay. That seems like a pretty good goal for the average hourly worker. Save $1,000, put it into your retirement account. We're not even talking yet about 401k matches and kind of all of the complexity that goes with it. $500,000 at 55, you said?
65.
At 65. So basically you would have about 50 grand to live on every year until tax-free until you get to the average life expectancy. Kind of when people die.
Yeah, and look, there's obviously other things that go into it with inflation and all of that kind of stuff. But when you think about it in the grand scheme of the median person has 80 to 100,000, this is 5 times as much as that, and you're contributing $83 a month it comes out to.
The reason I like the IRA too is it protects you from yourself a little. I think people are just naturally spenders, right? I don't know the stats, but I'm sure there's more people who spend more than actually save, and it protects you from yourself, right? It's like, hey, look, I know I can't touch this. You can take like $10,000 out for home expenses, like first time buyers and stuff like that, but it's a way to just be like, look, like it's one of those things like pay yourself first, right? And that's why a lot of companies will just take it out of your check so it doesn't even hit your account.
If you contribute Bitcoin to your IRA, what's that?
No, you want some trillionaire energy? You want some of that? If you're living your life to get to 65, to have $500,000 in your retirement account, and then you're going to live the last 10 years of your life free, you got the wrong plan in life, right? Life is hard. There's lots of complexity. People are put in really bad situations. You're dealt the wrong hand, all this stuff. But if you can change your mindset and say, my goal is not to wait till I'm 65 years old and to have $500,000 in my retirement account, and then I get to enjoy the last 10 years of my life when I'm old and I'm getting older and a lot of the opportunity is gone. If instead you can make decisions now when you're young to put yourself in a position, maybe it's not 65. Maybe you can actually do this when you're 55 or 50, right? It doesn't mean that you have to try to retire at 30 or 35. But what it does mean that is if you can basically retire at 55 rather than 65, all of a sudden, now you got 20 years to the life expectancy, right? Rather than only 10 years. And so I think a lot of people, especially in America, there's this whole idea of like, I'm going to work for 40 or 50 years and I'm going to go to work every single day. I'm going to work my ass off. I'm going to get money and then I'm going to retire. I can't wait till I get to retirement. I'm going to get my pension, all this stuff. But if you start to flip it on its head and say, I'm not working so that then I can go live, instead, I'm living and I do the work needed to be able to live the life I want to live, it completely changes the way that you think about it. And I think that's probably our biggest message here is if you want to do the bare minimum, you got to get to 65 years old, 61, whatever, pick the age that you want of retirement, and you can't have 100K because you will not be able to survive on a material amount of money per year if you only have 100K in your retirement. But that to me is option 2. Option 1 is to make the decisions when you're young, because if you're not just putting $1,000, what if you're actually investing $10,000, right? Which may mean you need a side job, may mean you need 2 jobs, may mean that you can't go buy something you want, like all the hard stuff. You may have to make the hard personal finance decisions, but if you can invest the $10,000 rather than $1,000, and you're able to put that into a retirement account. Now you can't because of some of the limits, etc. But if you could and it compounded, well, guess what happens? You're going to end up with millions of dollars in the account rather than $500,000. But if you don't want to put in a retirement account, you may just be able to put in the stock market. Yes, you'll pay taxes on the gains, but you'll still come out on top. And so the whole goal is live your life, enjoy it, but don't go buy dumb shit. Instead, be able to get the money that you need in order to invest. And what you find is rich people, sure, they own boats, cars, planes, all this stuff, but the average rich person is more interested in getting more investments than they are more material things, right? 80% of millionaires inherited $0. 33% of millionaires never made more than 100K in a single year. And so when you start to look at that data, what it tells you is that the average millionaire in America is not running out buying a bunch of crazy stuff. They're learning to invest their money, and that's what's driving their wealth.